The Hong Kong market is absolutely buzzing right now. It feels like a flood of new companies are all trying to go public at once, and they're all competing for your investment. It's that classic investor's headache, right? So many choices, but only so much capital to go around. The real question is, how do you find the signal in all this noise?
And that's exactly the problem we're going to tackle today. We've got 4 pretty hot IPOs, but just one wallet. So what's the play? Our goal here is to cut right through the marketing hype and build a clear, data-driven strategy. So let's dive in and figure out where the smart money should be going. Here's our game plan. First, we'll line up the contenders in what I'm calling the IPO gauntlet. Then we're going to put one company, Able Digital, under the microscope to see what really makes it tick. We'll dig into the financials, check if the price is right, and then, with all that intelligence, we'll lay out the final subscription strategy for all 4. All right, first up, let's step into the gauntlet. This is where we size up the competition. We've got 4 very different companies all battling for the same pool of investment dollars. Let's meet them. So, what are we looking at? 2 semiconductor plays, a consumer brand and an edtech firm, a pretty diverse group. Now, to really understand the dynamics here, we're going to do a deep dive on one of them as a case study. And we're picking Able Digital. Why? Because its business model has some really fascinating strengths. And, well, some hidden weaknesses that are absolutely crucial for any investor to understand. So let's kick off our case study on Able Digital. Look, before we can even talk about whether it's a good investment, we've got to get to the heart of what this company actually does. And honestly, the analysts have come up with a perfect way to describe it. This quote just nails it. It perfectly captures their business model. See, Able Digital isn't teaching students directly. Think of them more like the backstage crew for universities, totally transforming how courses are created and delivered in this new digital age. Their business really boils down to 2 main things. First, they're the digital producer. They help professors take old school textbooks and lectures and turn them into these dynamic video courses, virtual reality labs, you name it. Then, second, they're the classroom decorator. They go into physical lecture halls and upgrade them with all this high-tech gear, like panoramic screens and AI-powered recording systems. Now, it's really easy to look at this and think their advantage is all about the flashy tech. The AI and the VR, and sure, that's the lure, that's what gets clients in the door. But the company's real secret weapon, its lock-in, is actually something way less glamorous. It's massive service network. We're talking 251 service centers that provide what one analyst called babysitter-like support. They get so embedded in a university's day-to-day operations that it becomes a total nightmare for the client to even think about switching. Okay, so the business model seems pretty solid, right? But a great business isn't always a great investment. Now it's time to dig into the numbers. And this, my friends, is where a major red flag just pops right up. The profit you see on paper, it doesn't tell the whole story. Not even close. So here's the $1 million, or rather the 105 million yen question. For 2024, Able Digital reported a very healthy net profit. Looks fantastic, doesn't it? But here's the catch. Is that profit actually turning into cold, hard cash in the bank? And boom, here is the problem in black and white. The company reported a profit for 2024. But in the first half of 2025, their operating cash flow was negative 127 million yuan. That means they're actually burning through cash just to operate, despite what that profit line says. This is a classic textbook disconnect and a huge warning sign for any investor. So where'd the money go? Well, it's not lost. It's just stuck. It's sitting in accounts receivable. And this number is just staggering. In the first half of 2025, it took Able Digital an average of 282 days to get paid. I mean, think about that. They do all the work, deliver the service, and then they have to wait over 9 months to see the cash. That is a long time to be a bank for your customers. And the reason for this insane delay is a fundamental risk that's baked right into their business model. Some analysts have a great name for it: client dependency syndrome. You see, their customers are almost all public universities, and these institutions are notoriously slow to pay because their budgets are tied to slow-moving government cycles. This gives Able Digital almost zero bargaining power to get its money faster, and it makes them dangerously exposed if government education funding ever gets cut. Okay, so we've got a good business, but it has a really serious cash flow problem. So the next logical question is, does the IPO price actually account for this risk? Are we getting a good deal here? So when we put Able Digital side by side with a similar company on the mainland A-share market, Jaffa Education, things get pretty interesting. The PE and PS ratios are just quick ways to see how expensive a stock is compared to its profits and sales. And as you can see, on both of these key metrics, Able Digital is being offered at a really significant discount to its peer. The price looks much more reasonable. Now, before we get to the final verdict, we have to talk about a key piece of Hong Kong IPO jargon, the cornerstone investor. Basically, these are big-name institutional players who commit to buying a huge chunk of shares before the IPO even goes public. Their involvement is seen as a major vote of confidence. And here's the real kicker for Apple Digital. It has 0 cornerstone investors. It also doesn't have something called a greenshoe option, which is basically a tool underwriters use to help stabilize the stock price if things get rocky after listing. So what does that all mean? It means we've got a small deal with none of the usual safety nets. You should probably buckle up for a potentially volatile ride on day one. All right, we've torn apart the business, we've gone through the financials, we've looked at the valuation and the market structure. Now it's time to put it all together and deliver the final verdict on all 4 of these competing IPOs. So here it is, the final scorecard based on all the analysis. As you can see, both Able Digital and Xiao Noodles come out on top with a 4-star rating. The 2 semiconductor companies, Tianyu and Novosense, are rated just a little bit lower at 3 stars. So the final verdict is to focus on the 2 smaller deals. We've gone deep on Able Digital, and the conclusion is that its valuation is attractive enough to make up for those cash flow risks we talked about. Now, the other top pick, Xiao Noodles, is a totally different kind of play. It's a consumer brand, and its main appeal is purely structural. The IPO is so small that it wouldn't take much investor demand to really move the price. It's a classic supply and demand bet. So, here is the final actionable strategy. The call is to split your capital 50-50 and actively subscribe to both Able Digital and Xiao Noodles. And the recommendation is to completely skip the 2 semiconductor deals, Tianyu and Novosense. Plain and simple. That's the plan. And that really leaves us with one last question to think about. With these 2 top picks, one is a bet on a solid, though definitely flawed business with a reasonable price tag. The other is much more of a tactical bet on market dynamics and the simple scarcity of shares. So as you make your final decision, just ask yourself, which game are you really playing here?